after with very strong demand and constrained supply. You saw inflation in all the advanced economies. It was a little sharper here at the beginning. I think there's a role for monetary policy in that. There's a role for fiscal policy. There's a role for the pandemic, a starring role for the pandemic. You know, our job is to deal with it, and that's what we've been doing.
Well, thank you for always keeping small business in Main Street America in your calculations. And with that, Mr. Chairman, I yield back.
Gentleman yields back. The gentleman from California, Mr. Sherman, is recognized for 5 minutes.
Mr. Chairman, I want to thank you for recognizing in your opening statement the importance of immigrants in keeping costs down. And I want to thank you and the administration for what has been an excellent 2023 economic report. We've got 3.1% economic growth, by far the best in the developed world. Headline inflation, 2.4%. And that's not a little blip, you know, a one-month number. That's for the whole of 2023 and compares very favorably with the pre-pandemic portion of the Trump administration when we had inflation of 3.5%. My goal here is to convince you to cut more and sooner because for a number of reasons. The first is that I know, you know, if you ask a constituent, they want zero inflation and zero unemployment. You know that we can't have that and have concluded that the economy works best with a 2% inflation rate target. But I've looked at the history of that 2% number. It seems to come from Auckland from the 1980s. And there's a lot of arguments that your target should be just a little bit higher. Larry Summers recently produced a study arguing that the cost of money is part of the cost of living. So we have this weird paradox where you're trying to keep the cost of groceries down by raising interest rates, but as the ranking member points out, the big issue is housing. And your measure of inflation seems to treat all Americans as renters, even though 2/3 are homeowners. And so when interest rates go up, that's an increase in the cost of living for anyone with an adjustable rate mortgage, anybody looking to buy a house, anybody with a home equity loan. Obviously, we would cut interest rates a little sooner and a little more if your target was something closer to 2.3%. So I'll ask you, is there substantial economic analysis that argues that your target rate and the economy would work better if we had a slightly higher target than 2%?
Not really, no. What's happened is, you pointed out New Zealand, but what's happened is that 2% has become the global standard. And it's a pretty durable standard. I don't have any reason to think that it's a problem for the United States to get to 2% inflation. You know, we're at 2.4% right now, headline inflation.
I would ask leave to add to the transcript of this hearing numerous articles that argue for something between 2.3 and even 3%. I'm not arguing for as high as 3%. Let's look at Basel. There's nothing free here. If the standards are too high, we lose economic growth. If they're too low, we have bailouts and bankruptcies. But I think everybody agrees that the standard should be well crafted. You've got a system where everybody drafting this is well dressed and focused on Wall Street, and you've got Basel rules that discriminate against Main Street and for Wall Street. I'll give you some examples. 65 basis. It's 65% if you're a publicly traded company and make a loan to a publicly traded company. You make a loan to CalPERS, they're not publicly traded. Without objection, I'd like to put in their article into the record. And so they're, in effect, going to have a tougher time getting a loan. The local pizzeria is going to have a tougher time getting a loan. You've got, in Basel III, ignoring mortgage insurance, which obviously makes the loan more prudentially sound for the bank and is very necessary for first-time home buyers. And you've got a system where if you make investments in long-term bonds on Wall Street and you put them in the hold-to-maturity category, you don't have to recognize the losses and mark to market. So I hope you'll look at these in terms of the competition between Wayne Street and Wall Street for bank loans. Finally, we go to clean energy investment. Can I count on you to personally look at the paradox where Basel III treats clean energy tax credits much more harshly than low-income housing tax credits for no ascertainable reason?
Yes.
Thank you.
Gentleman's time has expired. The gentleman from Georgia, Mr. Loudermilk, is recognized for 5 minutes.
Well, thank you, Mr. Chairman. Mr. Powell, thank you for being here today. I'm concerned with the small dollar credit for businesses. As a former business owner for over 20 years, I can attest that as the small dollar business credit becomes more expensive and less convenient, businesses are going to turn to credit cards and other alternative financing for business purchases. These inevitably result in even higher costs, which goes down to the consumer, which means that they're going to pay more for the services or the products. But in February of this year, total credit card debt reached a record of $1.7 trillion. According to Intuit's Small Business Index annual report, average monthly credit card balances were 27% higher in 2023 than they were in 2019. What do you view as the driving force behind these record high levels of credit card debt?
Part of it would be growth in the economy, so that'll be part of it. Just that it's a bigger economy and a bigger number. I'm not sure what that is. You know, as you know, people had lots of extra cash during the pandemic from forced savings. They've spent that down. Now they're borrowing. I'm not sure.
So, if there was a rule to force banks to tighten lending, do you think the rule would drive businesses and consumers to alternative forms of credit?
I do. I think, you know, if you raise lending costs for banks, then at the margin that will make non-bank lenders,
Right.
you know, they'll get some of that business.
And if it becomes more complex or less convenient, then businesses will turn to these alternative forms like credit card. I can tell you that from experience. Yes. Well, I've called for the withdrawal of the Basel III Endgame proposal entirely. Will you commit to an analysis of how bank capital proposals like Basel affect small business credit access and the small dollar lending before finalizing such proposals?
I commit to that. Let me look into that. I don't want to make a commitment that I'll undertake some big study, but we'll look at the issue.
Do you feel it's important that we do have an understanding the effect it's going to have on small businesses? The backbone. It's the bloodline of our economy.
They create the jobs. That's
Yes.
right. I do agree. Yeah.
Okay. The chairman asked you for your thoughts on withdrawing or reproposing the Basel III Endgame proposal. Have you specifically discussed withdrawing the proposal with Vice Chairman Michael Barr or the other governors?
So I don't want to get into our internal, doings, but I will say that I understand it is a live option. Again, we're not at a stage of being able to even have that discussion yet because we're not really. We've got to decide first what changes do we think are appropriate, and that'll take a little time. And then the question will be reproposal. What I said is, when we get to that point, if reproposal is the right thing to do, we're not going to hesitate at all. It's a perfectly live option.
All right. In the current environment we have in politics in this country, there's not a lot that you find bipartisan agreement on, but I think you could find some agreement in withdrawing that proposal. Can you explain the importance of broad consensus at the Fed on proposals like B3E? Are you concerned with recent trends of disagreement among board members related to major proposals?
So I think we're going to get to broad consensus at the Fed. I do. I think it's very important. You know, this is been our culture that we try to find common ground, and we've been able to do that in the regulatory space, and I expect we will be here as well. And I'm committed to that.
Could it be that we're seeing this level of disagreement because of extreme measures that are being taken now that may not have been taken in the past? I mean, a total difference of opinion and understanding and philosophy regarding a free market economy.
I won't I won't speculate, but I will point out that 4 of the 7 governors during the open board meeting at which we put it out for comment expressed real concerns, very specific concerns about the proposal, and said we would look at the comments when they came in, and that's what we're doing.
All right. Do you feel that they have validity in their concerns?
I was one of the 4, so yes.
With the few seconds I have remaining, there's a recent report of FinCEN working with financial institutions to query legal purchases made by American citizens. Has the Federal Reserve been instructed within the past 3 years by Treasury or anyone else to search Americans' legal transactions?
Not that I know of, no.
Okay, thank you. I yield back.
Gentleman from Illinois, Mr. Foster is recognized for 5 minutes.
Thank you, Mr. Chair, and thank you for being here. As Ben remarked, there's a near-term emergency to get the $60 billion in military assistance to Ukraine. And separate from that, there remains a longer-term need for reconstruction assistance to Ukraine, which the World Bank estimates is somewhere north of $400 billion. Now, at the start of the Russian invasion, the free democracies of the world froze roughly $300 billion in Russian currency assets, primarily at European banks and financial institutions. And the Biden administration and many of our allies have recently taken the stance that those assets should be leveraged somehow to provide reconstruction resources to Ukraine. I support this concept, and I believe that additional action should be taken to ensure that we hold Russia accountable. But there are real concerns on the impact that this might have on central banking system, on the primacy of the dollar, the euro, and so on. And so my question is, have you seen just the act of freezing these assets and not seizing them, but simply freezing them? Have you seen deleterious effects on the primacy of the dollar, the confidence in the central banking system? Is there any visible downside from the act of freezing that's visible so far in the 2 years since we've done it?
I can't point to any. I can't point to any.
Okay, so that's an interesting observation when we think of taking the additional step of actually seizing them, that at least so far, because, to my mind, having them frozen is as violent as and as violent as seizing them outright. And so that's interesting that so far we haven't seen that. Now, in terms of the Basel III and so on, there is there's a frustration I've had over the fact that directionally the effects of these are clear, but the magnitude of effects are not. For example, if you talk about the effect on the prices seen by derivative end users of increased capital requirement, directionally it's clear. If you raise capital requirements, banks will withdraw from these markets to some extent. Other players will step in partly and take up part of the slack, and the spreads will increase and so on. Is the data that you've collected enough for you to actually estimate the magnitude of these effects instead of simply the direction?
I think it's really hard to get down to the micro level and try to assess that, because you're right, there would be multiple effects. But you do know that you know the direction, you know what the sign is.
That's right, but if you can avoid financial crises with a microscopic increase in prices seen by end users, that's one thing. If it's a very large difference in the price, so that the magnitude matters a lot when you're doing these balancing things. And a lot of it depends on, actually, you need a model for how the different market players will react. And is that really not going to be in the scope of the analysis that you anticipate from the quantitative?
I believe we have done some work on that, and I think the banks and other participants have done work on that as well, and come up with a range of answers. But this is there are just an awful lot of variables in these equations, so it's hard to say with any confidence. That's why it's hard to. The job of deciding the precise level of appropriate capital is a hard one.
Yeah, and now with 10 years, we've had two major crises with both a fiscal and a monetary response. Are there the lessons that you can learn now that, I believe, and it seems like your testimony indicates that we're kind of approaching back to normal now? And we've seen in the crisis of 15 years ago, we saw what many people thought was an inadequate fiscal response, that the fiscal response was less than half of the output gap. And we limited by political will to do things. And then, of course, you were limited by the zero bound in what you could do for most of a decade, and we had a long recovery. And the comparison, to the COVID recovery has been very sharp, and it's quite remarkably put us right back on that track. Are there any lessons that you've sort of drawn about the importance of the getting the right balance of fiscal and monetary response to these shocks?
So we think about that a lot, and I think I have to start by saying it's too soon to really tell, because the answers you would give today, the picture looks very different than what it looked like a year ago. And so, and a year from now, we'll be looking back going and saying, we've learned so much more. So I think the pandemic is still writing the story of our economy right now, and we should just be prepared to be surprised with the next chapter, as we were with 2023, the very strong growth, the sharp decline in inflation while the labor market remained very strong. Very few forecasters had that, but we can talk about it.
Gentleman's time has expired. We'll now go to the gentleman from Ohio, Mr. Davidson, for 5 minutes.
Thank you, Chairman. Chairman Powell, thank you for being here today and for your testimony. I'd like to start off, first of all, by completely echoing everything Congressman Barr said. A lot of us have talked about Basel III Endgame, and I think Congressman Barr kind of nailed the thought process. I do hope you'll kind of withdraw that and take the comments you've heard from here and from so many others about the hazards with the current approach. But I'd also like to address one of the other practices by the Federal Reserve, and it's the practice of paying interest on excess reserve balances held with the Fed accounts. It's my strong belief that rewarding banks with returns for taking no market risk actually harms our economy, and it discourages financial institutions from lending money into the economy. Instead, they park it at the Fed. This has little to no impact on very large corporations, but it can have a crippling impact on small and mid-market firms. And we especially saw this in the long recovery as Dodd-Frank was implemented in the Obama years, transition to the Trump years. We changed some of that mindset with a lot of other policies, but we saw a strong surging economy. So our country would pay a price for this market distortion by the Fed in two ways. First, they're unable to obtain loans at competitive rates because the money is sucked out of the market. Frankly, a lot of them don't even have access to lending except through bank capital. So it forces them into other forms of capital, equity capital, and others. Second, they ultimately pay higher rates whenever they have these alternative means of capital. And so today I've introduced a prohibition on the IOER Act, which would prohibit the Federal Reserve from paying interest on excess reserves. By eliminating IOER, we can begin to return our economy to the undistorted free market economy it's supposed to have. The alternative is you could simply raise requirements. We see some of those moral hazards when you do it across the board with approach like Basel. So what's your case for why you should keep paying interest on excess reserves?
Well, as you know, we don't see the downsides that you're talking about. Banks have a cost of funds and they have what they can earn, and that's what really matters is the spread.
And if they wanted to do it, they could simply buy treasuries on their own, and they could do that independently. I suppose they can independently keep it at the Fed, but they don't have to buy. They don't even have to put it on their own balance sheets in the same way. They've got immediate liquidity with Fed overnight account. So I don't see how that's different than what they could already do.
What I was going to say was, banks can earn a much bigger spread by lending to corporates. So their incentive to lend is the same as it always was. This doesn't affect that. Really, it's they have a cost of funds and they have the ability to have reserves, but that's not going to. They're not earning a profit on that. So, or a big one. They can earn a much bigger profit by lending to small corporates.
Well, speaking of profit, I mean, the Federal Reserve isn't officially supposed to be a for-profit corporation, but you are supposed to pay for your operating costs off of positive cash flow. And right now, the Fed doesn't have positive cash flow. In fact, the Fed has negative cash flow. So it's not entirely unrelated that the Federal Reserve operated at a $114.3 billion loss in 2023 and currently is carrying a $133 billion loss on its balance sheet this year. So it's, not the right approach, I think, to be paying essentially that much out in excess reserves to banks that are holding capital in the Fed when they could be deploying it into the market. So right now, the interest you're paying banks and money market funds exceeds the income you're getting on the $7.6 trillion balance sheet assets that you have, to the tune of $133 billion asset. So, effectively, the Fed is operating at an operating loss. So what's the path back to cash flow positivity for the Fed?
As you know, we've, for many years during the QE large balance sheet period, we've contributed way over $1 trillion in net earnings to the bank, which to the Treasury Department. So you can't look at the loss without mentioning that we've been, giving effectively $100 billion a year in profits every year to the Treasury Department. So the other side of that is when we raise rates to do the job you've assigned us to get inflation under control, when we do that, we absorb paper losses. It has no effect on our operating, the way we operate the Fed. And if we retained all the earnings we have, then it wouldn't be a problem. But we don't do that. We give that money to Treasury.
Thank you. And I think the last thing is I just encourage you to halt any effort to develop a central bank digital currency. It doesn't need designed, developed, and it certainly doesn't need established. I yield.
The gentlewoman from Ohio, Ms. Beatty. Mrs. Beatty is recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you to our ranking member, and thank you, Director Powell, for being here. Let me start by saying thank you for the monetary report. I've had a chance to try to peruse it, and there are headings in there that says the labor market remains strong. You'd probably agree to that, your report.
I would.
Let that say that's a yes. Also, it talks about unemployment rates being low by historical standards. You'd agree with that? It also states that the global pandemic played a huge role with the inflation rate, and inflation rates are on the decline. It's reported in several charts in here, and also substantiated by the Federal Reserve of New York and Michigan surveys that I've read. It also talks about job gains and uses the word robust jobs. So I want to thank you for educating us on that. And Mr. Chairman, I'd like the record to show that all of this also resulted during the Biden-Harris administration of making sure. So often we hear in this committee and other committees about what the administration is not doing and what our economy and jobs look like. Now let me move on to something that's very dear to me, and want to thank our ranking member for bringing it up, and that's the lack of affordable housing, which is one of the primary things that I hear about when I'm back home. I'm on more panels to try to explain what you do, what we do, or oftentimes what we don't do, and why we have this. While I know that interest rate hikes have successfully brought down the inflation, rising rates have also had an adverse effect on the cost and the pace of housing construction and costs. Are you concerned about the effects that interest rate hikes are having on the cost of financing new construction? And the second part, how do you expect to control for long-term housing inflation that might have a potential rate cuts, how it might affect that?
So our policy to bring inflation down is to raise interest rates, and that works through several channels. One of them is probably the most important, is interest-sensitive spending, and within that you have housing and durable goods and things like that. So, during the early days of the pandemic, the housing industry was about to all go bankrupt. And all of the facilities that we did really supported that industry through their critical time. When we're going in the other direction, when we're raising rates, housing is definitely affected. We understand that. It's not something we want to have happen, just it is the reality that housing will slow a lot when you raise interest rates. We've done that, and we're doing it for the longer run benefit of the people we serve to restore price stability, which is beyond value for people to have price stability. We get it that in the near term, that's higher rates, that's fewer sales, people are locked into low-rate mortgages, we get all that, but we got to do this because it'll benefit the country and people in the longer run.
And I have a great appreciation for that. But also, when I go back home to the district, what I hear a lot from agencies and individuals who work with advocacy groups, that the effects of interest rate hikes are not borne equally to all American households. So we hear that. And there's no doubt that low income and minority communities are hit the highest or the hardest by these monetary policy changes. Black households and business owners have historically faced challenges with home ownership and access to capital, and they're disproportionately impacted by the rate hikes. Does the Fed, do you have anything that you could help me with this dilemma and how we can better achieve economic goals in a more precise and equitable manner?
So I think it's working. You see inflation coming down, and that's why I do think it's likely at some time this year, if the economy, proceeds along the path we expect, that we will begin to reduce rates. So that's really the path that we're on, and I do hope it works out that way.
And when you say, I don't have a lot of time, but when you say economy, what does that mean? Helping poor people and black people get more jobs, more money?
So our forecast is for continued strong growth, a continued strong labor market with wages going up and also with inflation coming down. So that kind of an economy.
Okay, my time is up. I yield back. Thank you.
The gentleman from Tennessee, Mr. Rose, is now recognized for 5 minutes.
Thank you, Chairman McHenry and Ranking Member Waters, for holding this hearing, and thank you, Chair Powell, for being with us today. I'd like to start by discussing the Independent Automated Teller Machine Owners or Operators section of the Bank Secrecy Act Examination Manual. I want to ensure that financial institutions will not be discouraged from providing banking services to the independently owned ATM industry. In 2021, you made it clear that the industry does not automatically present a higher risk for illicit finance. I'd like to know what efforts have been made by the Federal Reserve to fully communicate that position to financial institutions across the country.
I will have to get back to you on that one.
All right. Thank you. Well, and so I might just add, listening to independent ATM operators over the time that I've served in Congress, I've come to understand that unfortunately, and it was in the Bank Examiner's Manual up until just about a couple years ago, these operators were identified as being extraordinarily risky, and that was causing them to be debanked in many cases. So I do hope that you'll take a look at that and make sure that we're communicating that to financial institutions and, most importantly, to the regulators. Chair Powell, Tennessee is home to over 1,000 foreign-based businesses that have chosen to invest in our state and create more than 160,000 jobs. These jobs are reliant upon cross-border financing provided by global banks, including foreign banking organizations. The Federal Reserve has long maintained the principles of national treatment and equality of competitive opportunity when regulating foreign banks and assessing them based on their U.S. operations. Are you still committed to these principles?
Yes.
And how will these principles be reflected as you move to finalize the Basel Endgame proposal?
So we have received a whole separate set of comments from the foreign banks, and we'll look at those, very much in that spirit and make appropriate changes.
Thank you. Chair Powell, the Basel III Endgame will incentivize firms to transfer credit risks off their balance sheets. One avenue for such a transfer is synthetic securitization, the framework of which must be approved by the Federal Reserve. However, it is my understanding that there is a substantial backlog of reviews and approvals of these securitization frameworks. It is concerning that the Federal Reserve is directing the risk transfer, yet also impeding it, in my view. Can you comment or can you commit to reviewing this approval process and taking steps to reduce the backlog of pending securitization applications?
So as I understand it, these transactions are becoming popular right now. There's a lot of appetite to do them, and we're not stopping them. We're just being careful because there were similar things that happened about credit risk transfer during the global financial crisis that didn't actually work out. So we want to make sure that these structures really do actually durably transfer. And we think that they do, but we just need to be careful because the last experience with these was difficult back in the last crisis. So it's just something that we're not intending to slow these down, and I think we'll try to get through it.
Is it a lack of available resources to apply to the approval process, or is it an intentional slow walking to make sure that every I is dotted, every T crossed?
I don't actually know, but I do. What I heard was, what I have been told is, we're not stopping these, but we're going to be careful with them and just be absolutely careful that they really do transfer credit risk in a durable, kind of sustained way. And that's the thing. And I don't think it's an intention to go slow or to have a backlog. It's just, and so I don't know what the staffing issue is. We'll check.
All right, thank you. As the Federal Reserve continues to consider proposals designed and debated in Europe, such as Basel III, has the Federal Reserve's Supervisory Climate Committee or the Financial Stability Committee had any discussions regarding the adoption of ESG risks in capital requirements?
I don't know.
Has there been any discussion in other committees regarding the adoption of ESG risks in capital requirements?
Any discussion, I really don't know. Let me say that's not something we're considering, but when you ask me any discussion, I don't know.
It's not a priority in
to
capital requirements.
To put it mildly, yeah.
Okay. Thank you. I see my time is running out. I appreciate your answers, and any further light you can shed on those matters, I'd appreciate. I yield back, Mr. Chairman.
The gentleman from Illinois, Mr. Caston, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, Mr. Chairman, for being here today. I want to start just with following up on the exchange you had with Mr. Sherman. As I think you know, I led a letter with 106 of my colleagues with concerns about specifically the clean energy tax equity provisions in Basel. I appreciate your commitment to look at that. I wonder if I could just put a little bit of a sharper point on it. Can you look at that before the rule is finalized and potentially issue some sort of an addendum to the rule? The concern I have is the number of banks who are a little bit frozen right now, waiting for some clarity on that, and I'd prefer we not slow down the rate of clean energy investing in our country if we don't have to.
I don't know. I mean, I think there's a proposal, and we're well aware of the commentary, and we're going to react appropriately. I don't know that we can pull one thing out of line and deal with it. But we're making good progress, and I think we'll be back reasonably soon with some answers.
Okay, well, time is of the essence. Appreciate anything you can do. Second thing, good thing about going late here, you get to follow up. I want to follow up on your discussion with Congresswoman Garcia here. I really appreciated your comments in the 60 Minutes interview last month when you mentioned that immigration is a big part of the story of the labor market coming back into balance. Now, generally, and correct me if I'm wrong, more immigration is generally going to ease inflationary pressure. Is that all else equal? Is that a safe characterization?
It's probably closer to neutral, actually, because people come in, they also spend. So it's not clear that immigrants coming in, they add to GDP.
Okay, so either we're going to get economic growth and/or downward pressure on wages.
More workers, that wages might go up a little bit less, but at the same time they're also spending. So we had this conversation. It depends on what you assume, but I think it's better to just assume it's sort of broadly neutral from an inflation standpoint.
So I guess, and maybe you've answered the second question, but given as you all are using the Census Bureau data that is more conservative than the CBO data, and obviously we're all making estimates in the future, can you speak at all to whether your forward views on economic growth and inflation, how sensitive are they to your assumptions about that census versus CBO data on what the actual level of immigration is to the country right now?
I think the CBO assumptions are meaningfully higher and would affect growth and would be part of the explanation why growth was strong last year and would be a reason to expect. I mean, it's not the main reason, but it would definitely add to growth this year. And I wouldn't say that we accept one version of the other. We study the CBO numbers carefully. We're just trying to get to the right answer. And I think the CBO shows, and they say so, stronger growth, higher growth, more people. I don't know the per capita growth goes up, but the absolute level of growth goes up.
Okay. Last question. I think there's a lot of good news in the monetary report that you all just issued around wage growth. We've seen, the lower quartile of earners starting to close some of those historic gaps. We've seen minority groups and women start to close some of those gaps. What I didn't see, and I don't know if this is because you all haven't done it or I just didn't read closely enough, have you seen any gaps regionally within the U.S.? Are there parts of the country that are seeing stronger wage growth than others?
There are. I don't have that off the top of my head. I want to go back and, if I can just, when I talked about immigration, I think that the immigration story for last year was part of the positive supply shock and was part of the reason why inflation came down. I was really asking the question over the longer run.
Fair enough.
And there, I think it's more
Fair
likely
enough.
to be neutral.
I want to appreciate that. I want to just close on this regional piece because the Atlanta Fed, which is the best I could find that looks to do at least some by census regions, that as I look through, there's and you look at which regions are consistently running above. I think that New England and the West are consistently showing wage increase above average, and the West, South, Central, Texas, Oklahoma, Arkansas, Louisiana are consistently, I think going back to like July of 2022, consistently seeing wage growth below average. And I appreciate you're not going to wade into a political question here, but those are all right-to-work states where it's harder to unionize, where it's harder to organize. And what I'm wondering is, without asking you to opine on policy, have you all at the Fed done any analysis that says, as we look at when there are gains in labor productivity, does that gain in labor productivity, is it more likely to accrue to workers in those states where there's a stronger union presence, easier to organize, and more bargaining power for labor as opposed to capital?
My guess is there's plenty of research around that area, not necessarily at the Fed, but we'll take a look and come back to you.
Okay. All right. Thank you. I yield back.
Gentleman's time has expired. Now go to the gentleman from South Carolina, Mr. Timmons, for 5 minutes.
Thank you, Mr. Chairman, and thank you, Chairman Powell, for being here today. We continue to appreciate your work and the work of the Federal Reserve on behalf of the American people. In August of 2023, the Federal Reserve, FDIC, and OCC released the NPR requiring the issuance of long-term debt for Category 2, 3, and 4 banks. As you may know, I, along with many of my colleagues, authored a letter to each agency expressing concerns regarding the lack of tailoring in the proposal and shortcomings in estimating the actual cost of the proposed rules. I'm concerned that these shortfalls will negatively impact lending in my district, and when combined with the other ongoing regulatory proposals, could cause further consolidation of the banking industry. It appears that the Federal Reserve has primarily deferred to the FDIC concerning the proposal. Could you shed light on the Federal Reserve's role within the rulemaking process concerning the long-term debt proposal? And have you provided input regarding the proposal's interplay with Basel III Endgame?
I think we're one of the proposers of the rule, just like the other agencies are. And right now we're looking at the comments that we've gotten. That comment period, I believe, has closed. Yeah, and so we're very much in reading those comments as the law.
You're in the middle of
do.
it, fair to say. Okay, thank you. I'm concerned that the long-term debt proposal's lack of tailoring contradicts the statutory requirements of the Economic Growth, Regulatory Relief, and Consumer Protection Act. Instead of applying tailoring principles, this proposal creates Category 2, 3, and 4 financial institutions identically for the purposes of long-term debt issuances. Additionally, the proposal unduly burdens Category 2, 3, and 4 banks by requiring them to issue long-term debt at both the parent holding company and bank level, which actually could be viewed as reverse tailoring, considering GSIBs are only required to issue debt at the parent company level. What is the underlying rationale behind this dual requirement, particularly when such a mandate is not imposed on our largest banks? And do you believe that this represents a tailored approach as required by the statute?
So that tailoring question is one of the questions we'll be asking ourselves as part of our review of the comments.
Thank you. It's my understanding that Category 4 banks were not included in the original advance notice of proposed rulemaking for the long-term debt rule released in the fall of 2022. Is that your understanding as well?
I didn't catch that.
Did the advance notice that was released in the fall of 22 include Category 4 banks? It's my understanding that it did not.
I can't confirm that, to be honest.
Well, I think that's something that you should take into account because the Category 2 and 3 banks have had an additional year to foresee this challenge, and so Category 4 banks are really behind the 8 ball. And yeah, so I guess my next question is, do you believe regulatory agencies should provide smaller regional banks longer than the 3-year phase-in period to meet any final long-term debt requirements?
It's a good question. That's one of the comments we've gotten, and we'll be looking at that.
I just think if we're going to impose these new regulations, giving everyone the same opportunity to comply with them is something worth considering. I guess one final question. If these proposed regulatory changes had been in effect prior to the fall of SVB and Signature, do you believe the outcome would have been different? Because honestly, I don't think anything would have changed.
You know, it's a hypothetical. I'm tempted to say that if there had been more long-term debt there that was specifically there to absorb losses.
They were nowhere near being solvent. But I guess that's something I think y'all should take into account, whether if these proposed changes to our system that are designed to make it more resilient would have actually caused SVB and Signature to have a different outcome. Because again, it just seems that my colleagues across the aisle let no crisis go to waste, and these are changes that would not have in fact prevented the calamity that they are justifying the changes based on. Thank you for being here today, and with that, Mr. Chairman, I yield back.
Gentleman yields back. The gentlewoman from Massachusetts, Ms. Presley, is now recognized for 5 minutes.
Thank you. Due to the Fed's aggressive interest rate hikes, mortgage rates have surpassed 7%, rising to 20-year highs, leaving many credit-worthy and mortgage-ready homebuyers without a path to home ownership. This is a problem for everyone. It's an urban issue, it's a suburban issue, it's a rural issue. Chairman Powell, I welcome the decision of the Fed to pause rates at the end of last year. But for families in my district and across the country, that is not enough. We need the Fed to start cutting because, like the rent, interest rates are too damn high. Chairman Powell, you've previously indicated that the Fed may cut rates this year. What would you expect the impact of lowering interest rates to be on the housing market specifically, including the rental, purchase, and construction market?
So we know that higher rates, of course, have slowed down the rate of activity. So if at such time as we start to lower interest rates, housing market will pick up broadly across new home construction and new home sales. The number, as you know, many households are in very low rate mortgages, and they really can't sell because they have to refinance into a high rate mortgage. That'll go away over time. So ideally, the housing market would go back into a more normal phase, but one with lower inflation in the broader economy.
Right. So just to further reiterate that, interest rate cuts would have a great benefit. Just yesterday, actually, I met with a number of representatives from state housing finance agencies from throughout the country, and they were talking about the barriers to affordable housing projects given the current interest rate environment. Obviously, higher interest rates have raised costs for affordable housing developers, and many of them have chosen to slow down or halt construction entirely. So fewer homes are being built, which means fewer people are being housed. So given that would you agree? So given that we already had a massive shortage of affordable housing supply prior to the pandemic, when interest rates were below 2%, the current rate, 5.5% rate, has been devastating. And the price of homes across the country have remained stubbornly high. It's clear that the current state of our housing market is impacting everyone and disproportionately hurting those who need stability the most. Does this concern you?
So our job is to do price stability and maximum employment. We don't target the housing market, and we're doing our jobs. That's what we're doing. It's not something we want to see, but
does this
impact
impact on the housing market? But does it concern you, Chairman Powell?
Does it concern me?
Yes. Fewer homes are being built, so fewer people are being housed.
This is the job we've taken on.
All right. Well, it concerns me greatly. Chairman Powell, the Fed's interest rate hikes have not been sufficient in addressing housing inflation. Do you agree that we need a more robust fiscal response to increase the supply of affordable housing and to lower costs nationwide?
So we don't take opinions. We don't express opinions on things like that. I will say that there is a structural housing shortage in the United States, and that's really the longer run problem. The problem with high interest rates is a short run problem. The longer run problem is lack of supply.
Well, that's why it is critical that Congress pass legislation and appropriation bills that will make those necessary investments in housing for all. You know, given the way that Ranking Member Waters fought for a $150 billion investment in housing and Build Back Better, I know on this side of the aisle that my colleagues and I are ready and waiting for the Republican majority to take housing inflation seriously. Housing affordability is the #1 issue I'm hearing about from my constituents. Families in my district and throughout this country need relief now. I truly hope the Fed will listen to them and cut interest rates. Thank you. I yield.
Gentlelady yields back. The gentleman from South Carolina, Mr. Norm, is recognized for 5 minutes.
Thank you, Chairman Powell. I think other people have noted about the crisis in the office building market across this country. That's a line of work we're in. I can tell you it's real. I can tell you the buildings that are effectively vacant, it's going to have an effect on the taxes paid. It's going to have an effect on rents. As far as affordability in housing, you know, the rates are one thing, but my good friends on the other side of the aisle don't realize that housing has got over 200 components to it. One of the biggest is gas prices. And as long as we're buying gas from countries that hate America and don't manufacture our own, housing isn't coming down. I don't know how you define affordable anyway. It's going to continue a downward slide. And I'm from a state in South Carolina that people are moving in. And we're not going to have the housing starts that we should have because of the policies of the Biden administration, which is train wrecking this entire economy. On regulations, on Regulation 2, which is has the guardrails for credit card fees, how do you answer and I know the caps you're looking at adjusting that. How do you answer the charge that this is really should not be, you're getting in the way of banks charging fees according to what their costs are? How does the regulations affect that, particularly Regulation 2?
Is this a Fed regulation we're talking about, or is this a CFPB regulation?
No, this is, for my record, it's the Federal Reserve has finalized the routing restrictions and proposed tighter and adjusting the price caps that currently exist. Is that not right?
It doesn't ring a bell with me. It may well be right. I'm not familiar.
If you could look at that, I know all the credit unions and banks have got some concerns on that.
I will come back to you on that.
Okay, I appreciate it. Do you need a letter from us? Or
No, we'll come back to you.
Okay, thank you. CRA, for those of us who have been involved with banking for a long time, the regulations having a clear set of standards that we abide by and know where to put the money to. When should we have regulations out that we can read about what's going to be acceptable and what's not?
Sorry, I didn't get your question.
The regulations on the changes in regulations for CRA.
Right. What about it? I'm sorry, I missed your question.
When are the regulations going to be out that we'll know, the banks will know what's acceptable for CRA and what's not acceptable?
So the final rule, of course, is out. I think we're working on. There's a lot of work to do. The requirements don't really kick in, most of them, for a couple of years at least. So I think we're working on the follow-up regulations.
Okay, that's really important for all the banks because they want to make sure they qualify, and where the dollars are spent, they need to make sure that it's going at the right spot because the credits won't be applied unless that's it. The Fed now, where the Federal, I think, Reserve launched and is operating this now, how is the participation rate going with that?
Slow, real slow. It's early days. There are network effects. These things they go slow until they don't. And it was the same way with ACH. You may remember back in the day.
Right.
So we're at fewer than 500 banks are in there now. We're working away at it. We expect it'll take some time, but it's there, and we think it'll be beneficial. We had a lot of support from smaller banks to build it, as you know.
Is the pricing below cost?
I don't believe so. No, not longer run cost.
Okay. Okay, that's all the questions I have. Thank you for being here.
Gentleman yields back. The gentleman from Nevada, Mr. Horsford, is now recognized for 5 minutes.
I want to thank the chairman and the ranking member for this hearing, and to you, Chair Powell, for appearing before the committee to discuss the recently published monetary policy report. As we continue our work on behalf of the American people, we have to keep in mind that our mission here is to grow the economy from the bottom up and the middle out. It seems as if there has been a constant series of shocks to the economy, both domestically and globally, and yet we can all see just how resilient the labor market has been as it has maintained its strength. With a robust gain of 353,000 jobs, the January numbers are a continuation of the trend that Democrats in Congress delivered through historic investments in our workforce, putting people over politics. In light of this relative economic strength, I really want to implore the Federal Reserve to take stock of the holistic economic picture before making decisions on monetary policy, and to pay particular attention to those communities that have been historically left behind during times of accelerated recovery. I want to add to the questions from my colleague, Congresswoman Presley, Chair Powell. At a time where it has become increasingly difficult for working people and people of color in particular to purchase a home, I worry that rising mortgage rates will put working families even further behind on accessing the wealth and equity that a home provides. So what actions, if any, is the Federal Reserve considering to better understand and to mitigate the impacts that your Basel III proposal may have on minority borrowers who disproportionately rely on high LTV mortgages due to the generational wealth gap that persists?
We've received comments, including many, on the mortgage changes, and we understand the concerns, and we're looking very carefully at that. Haven't made any decisions, but we will announce them when we have.
Are you concerned that these shifts in risk weights will reinforce the decade-long retreat of banks from the mortgage market and push more originations to non-bank institutions?
That's a question that people are raising, and it's something we take very seriously, and we'll be taking that into consideration as we decide about that change, that recommended change.
Could you discuss why you feel it is necessary to include new requirements around operational risk in Basel III in light of recent claims that it will significantly increase the cost of or prevent banks from offering altogether necessary services such as underwriting, investment advisory, or insurance?
That is one of the concerns that's been articulated about the proposed changes to operating risk. We take those concerns seriously. As I mentioned, we're in the middle of looking at these things, and then we'll soon, in the process of turning to the question of what changes to make.
Well, I just would underscore the sense of urgency, because the longer there's uncertainty in the market, it creates really negative effects to end users, which are all of our constituents who are looking to see these costs come down. Let me shift. This Congress, under the leadership of Ranking Member Waters and former CBC Chair Joyce Beatty, I've made it a focus of my efforts to educate my colleagues and the public at large on the far-reaching benefits of increased diversity in the workplace, in our boardrooms, and in society as a whole. Despite the efforts by some on the other side to take away the very tools of economic opportunity that create inclusive work environments and improve performance, there has been a really misguided assault on everything from diversity, equity, and inclusion to other programs following the aftermath of the Supreme Court's ruling on affirmative action. So, Chairman Powell, as you know, your Office of Minority and Women Inclusion has a focus on this. So as we anticipate the upcoming release of your annual report on inclusion, would you be able to speak to the necessity of collecting this data that minority and women-owned businesses are included in the board's contracting and acquisition opportunities?
I do believe we collect that data, and we monitor that very carefully.
And why is it important?
Well, I think diversity in the workplace is an important thing, and you won't know how you're doing unless you measure it.
And just as the McKinsey Institute released in their Diversity Matters Even More report, companies that have more diverse management teams actually outperform companies that don't. That goes to the bottom line of our economy, and I wish my colleagues on the other side would stop their assault on diversity, equity, and inclusion and actually work with us to grow the economy
Gentleman's time
for
has
everyone.
expired. The gentleman from Wisconsin, Mr. Stiles, now recognized for 5 minutes.
Thank you very much, Mr. Chair. Thank you for being here, Chairman Powell. Appreciate it. You're navigating a difficult situation where we've had stimulative economic policies from the Biden administration, in particular, excessive government spending, investment in infrastructure, specific tax credits. At the same time, we're seeing a regulatory environment from the administration that's also restricting economic growth. We've heard a lot about the Basel III Endgame, which you have a chair of. In your opening remarks, you noted that high interest rates are impacting business investment in a negative way. High interest rates are also negatively impacting the housing market. As we look at Basel III Endgame, I've heard from a wide array of stakeholders, from those that are commenting on increase in bank capital standards, the negative impact that would have on the housing market, as well as from the business community, the impact that would have on their ability to invest in capital infrastructure and increase employment. Does the broad diversity of voices who hold concerns on the Basel III Endgame concern you?
I would say that I've articulated concerns, and we're reading those comments, and we're very much in the process of assessing what we need to do to address them.
Thank you, and appreciate your time on that. Shifting gears slightly, as you may know, the Securities and Exchange Commission held an open meeting today to approve the final climate change rule. It's a significant regulation that I think would have a significant impact on the economy. Can you comment how the Fed thinks about the economic impact of this new regulation, or regulations more broadly, and in particular their impact on both inflation and on employment?
We don't comment on regulations of other agencies, sorry.
And you'll review that if it's put in place, or you'll review the economic impact as the empirical data comes forward?
We're not in the business of scoring, CBO does that. They'll look at this and make a careful assessment of the economic impacts and budgetary impacts and that kind of thing.
Thank you. I'll shift gears again. One of your two mandates is to maximize employment in addition to maintaining price stability. And as you know, government hiring has accounted for a large share of total job creation. More than 600,000 public sector jobs were created last year, and the federal government now employs nearly 3 million workers. So when you're examining employment data, how does the Fed view the impact of the public sector employment growth relative to private sector economic growth? In other words, how do the two data points factor into your assessment of how the broader economy is performing?
So the jobs are jobs, right? But I think we would tend to look at private sector jobs to get a better assessment. Private sector job creation is a better indicator of kind of the private sector momentum in the economy. But we look at both. They both count.
And does the dramatic increase in the private sector number of jobs give you any pause or concern as it relates to...
You mean in the public sector?
In the public sector. Sorry if I misspoke. Yes, the public sector.
The truth is the public sector was unable to hire at the beginning because wages went up a lot in the private sector at the beginning of the pandemic inflation, and public sector can't respond to that. So there's some catch-up hiring going on there now. Now that things are settling down to normal, I think there's some catch-up hiring. I'm not sure it's an issue we're concerned about.
Okay. I'll shift gears in my final minute just to talk a little bit to get your perspective on the macroeconomic developments that are having an impact on our monetary policy, specifically as we think about the potential for a productivity boom, from AI to work at home to other factors. The data is probably too early to tell whether or not we're having a true productivity view. But how does the Fed view the adoption of some of these new technologies, in particular AI, as it relates to labor productivity?
So everyone's looking at AI for that question, and it's hard to say, actually. We've had really nice productivity in the last year or so, but it's probably still very much affected by the post-pandemic factors that we're seeing. I think we need to see more to understand whether there is a longer-term boom. AI certainly has the capacity to either augment labor or to replace labor, and that's a key question. We really don't know which of the two it will do. Tons of money being invested in it, and so it's likely to drive significant productivity. I would say right now technology, but also higher labor mobility, a lot of people quitting during the really tight labor market, and also the rise in startups. There were a lot of people starting companies during the pandemic. Those are the kind of things that do add up to higher productivity over time. So there is hope that we'll see some productivity out of this.
Thanks for your comments today, Mr. Chair. I yield back.
Gentleman yields back. We'll go to the last questioner of the day, the gentleman from New York, Mr. Torres, for 5 minutes.
Thank you, Mr. Chair. Mr. Chair, I have several questions about some of the most common complaints that I've heard about Basel III Endgame. I have an open mind on the subject, but I want to hear your response to some of the arguments that have been leveled against it. First, the Fed has repeatedly reassured the public that the banking system is well capitalized. Yet the Fed is advancing Basel III on the assumption that the banking system is undercapitalized. So the first question is, how do you reconcile the Fed's repeat assurances about a well-capitalized banking system with Basel III's assumption of an undercapitalized banking system? The second question, if the purpose of Basel III is to align U.S. banks with their banking peers elsewhere in the world, why is the Fed imposing requirements that are more stringent than those prescribed by Basel III? In other words, why is the Fed, quote unquote, gold plating? The third question is, how do you reconcile Basel III's recommendation for standardization with Congress's statutory requirement for tailoring? Standardization would seem to be in conflict or in tension with regulatory tailoring. And the fourth and final question, do you think that Basel III could have the unintended consequence of reinforcing the trend toward shadow banking, which would mean less regulation, not more? Is there a sense in which we are transferring risk from the regulated sector of the financial system to the deregulated sector? So I bombarded you with 4 questions, and I'll give you the time you need to answer them.
I'm going to have a hard time reading my handwriting here, but I'll start with yes to the fourth one. I'll give you that one because that is clearly a risk. We've seen intermediation activity moving out of the regulated system, and this has the risk of doing more of that. So what was, in a word or two, what was the one again?
Just you said, and you testified
capital, yeah.
repeat reassurances about the capitalization of the banking
So
system.
I addressed this in my remarks in the open board meeting. You know, higher capital is always going to add to safety and soundness, but there's a cost.
Right.
And so identifying the precise right level is very, very difficult. It's hard to do it objectively. I've said for years in these rooms that I thought that the level of capital in the U.S. banking system was about right. So I posed, and I voted for all these increases during Dodd-Frank. So I think it's a very fair question. We'll be looking at that. The second one was
the concern about gold plating.
About
gold plating?
Oh, gold plating. Yeah, no, it is, and I said this in my public remarks that we're exceeding the minimums with this proposal, and we also exceeded what the other big jurisdictions are doing. And so that's a question. That's a good question. I'll agree.
Okay, great.
And the third?
And the third is, I think you more or less, and standardization versus tailoring.
Standardization of, it was something.
Yeah, so Congress passed a statute requiring regulatory tailoring.
No, that's an
and do you think
question.
Basel III is in compliance with that statute?
I addressed that in my comments too. I think you're right. We do need to take on board the lessons of Silicon Valley Bank as it relates to the smaller, large banks, but we don't need to throw away the tailoring that's required by the law, but also that is appropriate if we're going to have a diverse banking system.
You know, the collapse of SVB was largely a story about liquidity risk and interest rate risk, yet the focal points of Basel III are credit risk, market rate risk, and operational risk. Like, what is your response to the criticism that the Fed should focus its energies on addressing the forms of risk that were responsible for the SVB bank failure rather than focusing on forms of risk that were largely unrelated to it?
So I agree with that, but I would say we are working on a package of liquidity measures which directly addresses the Silicon Valley Bank situation. We've also taken a lot of supervisory actions with other medium and small-sized banks that had a lot of uninsured deposits and